Good morning, everybody. Thank you so much for joining us. We're just going to take another half a minute here to allow folks to get on the call who plan to be on the call. Have several dozen of you with us, keen to hear an update on the investment performance of the assets that we stored at the foundation, as well as a programmatic update on safety net grants, which is coming your way in just half a minute here. I'll say a few things at the top that you've heard before in calls such as this. We really want you to participate and contribute to the conversation. And the way to do that will be through the chat function and through the messaging function. If Luz, you could maybe page down. There we go, your audience Q&A, as well as the participant chat, and we'll do our best to get through those questions either on the fly or at the end of the investment segment that Jim will lead, or the programmatic segment that Julia and myself will lead. Naturally, we're recording this because there is a robust secondary market for these calls. You wouldn't believe it, but people ask me, say, "Hey, I can't be there. Are you taping it?" And I said, "Sure, we're taping it." So I think without further ado, my only job off the top here is to say a warm welcome to Jim Milligan from Baker Street Advisors. This is the independent investment advisory firm that guides the investments of the foundation and has for about a decade. So welcome, Jim, and the floor is yours.
Thank you, Terrence. Well, I will go through the financial results of the three main portfolios and the two ESG portfolios, and open it up to questions. And once I'm finished. So if we could turn to the first page of the presentation, please, Luz. Essentially, as most people know, this has been a tale of 2 years in the first 6 months of the year. The first quarter was a pretty rough quarter and in the financial markets, and the second quarter was a big, huge bounce. So you can see that the MSCI All Country World Index for the quarter was up 15%. That's the global equity benchmark, and after being essentially flat for the first quarter of the year. And bonds had a slight bounce in the second quarter, but didn't quite offset the losses realized in the first quarter. So bonds, the Barclays Ag, representing the most broad-based U.S. bond index, was down 43 basis points year to date through the second quarter. So if we turn the page and look at the results of the intermediate pool, here you can see this table is as of the end of the second quarter, where the intermediate portfolio was up 6.5%. And it has since, when we looked at this on August 10th, this portfolio was up 6.08%. So it had given up just a little bit since the quarter to August 10th. But we're very pleased with the results. And essentially, as you can see in the gray lines here, this is really something where stocks are driving these results. Your aggregate public equities being up about 12% year to date, and whereas your bonds were only up 1%. And we are pleased that our two bond funds outperformed the bond index of Barclays Ag made 62 basis points. Our two bond funds made 1.14%, so continuing to outperform. I might just highlight that, over the 10 years that we've been working with Napa Valley Community Foundation, this portfolio is up 6.71%, and it truly is meant to be an intermediate portfolio. And I'll demonstrate that in the next slide, intermediate in risk, that is. So this chart is an attempt to look at risk versus return. And essentially, return is on the vertical axis, annualized time-weighted return. And the risk of these various asset classes in your portfolio is shown on the horizontal axis under standard deviation, a measure of risk. And you can see the X is global equities, where the standard deviation is probably around 13%, and returns have been close to 20% over the last 3 years, whereas bonds represented by the circle have had a return of about 4% and a standard deviation of about 5, 6%. This portfolio is represented by the red square. So you can see that we're getting a good chunk of the return of bonds, I'm sorry, of equities with a lot less risk. So the risk of the portfolio is about 7%, and the risk of the and the return of the portfolio is over the last 3 years more like 12-ish%. So moderate to intermediate risk is the way I like to think about that. The next slide shows the return of the long-term portfolio, and this is a more aggressive portfolio. This is designed more for the equivalent of a 75% stock, 25% bond type of portfolio, and the returns are much higher. So the return over the last 10 years has been 9.27%, year in, year out. And then the return this year through August 10th is up 11.82%. So this portfolio actually rose a little bit since the second quarter, where the results were 11.5%. So we basically use the same investment vehicles. We just have a different asset allocation where we have more stocks in this portfolio. And that's shown in the next slide, where you can see that red square is much closer to the X of global equities, where returns over the last 3 years have been 16, 17%, but the risk is quite a bit lower in the 10, 11% range as opposed to 13%. And then our next slide will show the results of the short-term portfolio. And essentially, this portfolio is up 1.89%, and that's through August 10th. But the performance through 6/30 is 1.59%. That performance is mislabeled at the top there. It should be 8/10/26. This is designed to be, short-term liquidity providing investments. We would expect this portfolio to return about what treasuries, short-term treasuries and Fed funds return. So if this returns over the balance of the year, something like 3 to 3.5%, that's what I would expect it to do. So if we turn to the next page of print, why do we have 3 funds? Well, essentially, it's really designed to give donors the ability to pick and choose the portfolios that are most appropriate for their giving outlooks. So for any funds that we feel like fund holders are planning to give away in the next 18 months, we would suggest that you look at the short-term pool, which is more of a capital preservation fund, investing in money market funds, getting as much yield as money market funds will allow. So that's that portfolio. The intermediate portfolio we think of as a pool of assets that are designed to invest monies that you intend to donate in the next year and a half to 5 years. And that way it's more conservative than the long-term pool, but it's designed to dampen some of that volatility by having a higher allocation to bonds. And then the long-term fund is really anything that you intend to give away more than 5 years and really want to grow those assets so your gifts are more meaningful in a longer term horizon. And then, as you know, we have two of these sleeves that have their own portfolio that's focused on screening out ESG. And so those funds are relatively new, but we have one for the intermediate portfolio and one for the long-term portfolio that for those that want to invest in a values-aligned way. these are your funds. So then the next slide is a dense table, but essentially we work closely with the finance committee of Napa Valley Community Foundation, and basically the finance committee has set up the benchmarks for these policies. We've worked with the finance committee to set up investment policy statements for all 5 of these portfolios. And then they ask us to compare our performance to the benchmarks. And as you will see, we are at or above the benchmarks for all time periods, and we're very proud of that. But that is part of being good stewards for the capital that you've so wisely chosen to give to Napa Valley Community Foundation. So for the next couple of minutes, I'll spend a little of attention to what do we see going forward. Page 14 loose just says, all right, here's where we are. The Federal Reserve has decided to hold its interest rate targets at 3.5 to 3.75%. This just shows you returns, but we had a volatile first quarter and then a great second quarter. Inflation has been certainly on the attention of the markets. Our new Federal Reserve Chair, Chairman Warsh, is also on everybody's mind, along with AI and other themes. A couple of things that I wanted to touch on would be page 17. Markets are very focused on inflation. Here are the latest readings on inflation, and this graph was printed before the last one came out, and we know the August print was a good inflation print, but that right tail we want to continue to see flat to down, and some of the challenges going on in the Middle East are definitely challenging that steady decline. But something to focus on. The next slide just shows bond yields, and there's a bit of good news, bad news here. So as you can see, the light blue line is where bond yields were at the end of the year. So if you see the 10-year bond is showing at about 4.2%, whereas on August 10th it was 4.7%. So bond yields have backed up. That's why bond prices are sort of offsetting income this year, and bonds are essentially flat. But the good news is our bond investments are now yielding 4.7% plus spreads on the various vehicles that we're using, as opposed to the start of the year of 4.2%. So I feel like our bond investments are even more valuable now because the income is higher. And then the last slide that I wanted to touch on is, while there's a lot of talk about the Magnificent Seven, if we turn to page 20, we'll see that I think this would have surprised everyone. You can see that the S&P 493 has meaningfully outperformed the Magnificent Seven this year. And the Magnificent Seven obviously are stocks like Apple and Meta and Google, and those have been really leading the markets. And what I think most people are comforted by is that the breadth of the rally in markets has been quite substantial, and very meaningful. So a lot of people think, gosh, how much higher can this market go? And I profess that I'm always anxious, but corporate earnings have been the reason that this market has been going higher. Corporate earnings have been strong, and analysts look to them to continue to be strong, and that's why our equity markets have been so strong and our returns have been so great for the last few years. So I thought I'd end my comments there. And Terrence or Julia, or Luce, if you see any questions, I'm happy to address them. Otherwise, I'll turn it over to you, Julia, and hear about program.
Thank you,
Thanks,
Jim.
Jim.
There is one question from Kevin who's curious about inflation and the outlook for inflation and what the Fed may do next. Do you have a house view on that?
So what I would say is it really depends, I believe, on what happens in the Middle East, and it's too hard to predict exactly what's going to happen there. Um, but hopefully we can find a way as a world of nations to navigate this conflict in a way that where oil prices can tame down and things can get back more to normal. But that's the variable that if you tell me where that variable is, I'll tell you where inflation and bonds are. That's really critical. But I would say that our economy has done surprisingly well on the inflation front, in spite of that.
Super, thank you. And I just encourage folks to drop any other questions into the chat at the bottom of your toolbar. You'll see the little chat, and we'll try to get to those questions. And we're reserving time at the end, and Jim's going to stick with us. So now we can get into the program side of things. So today we're going to talk about the Safety Net Fund, which we named in honor of Elaine Jones, who was a great champion of the public benefit sector in our community, as you all know. And a year ago, with help from many of you on this call, we were able to distribute nearly $1.7 million to 14 or 15 organizations. Go ahead and page down, Liz, if you don't mind. Because we saw the need and we saw it coming like a slow motion unfurling of stuff around basically macro events, meaning policy changes in Washington, HR 1, the end of pandemic era subsidies around healthcare that expanded access to healthcare, all of that barreling towards our community where the typical nonprofit that we support because of your support, it's got an operating budget between $1 million and $10 million. And typically 50% of their annual expenses are covered by two things: government grants and contracts, not all of which are federal, but many of which are. And those are being taken away or downsized. And program services revenue, which often takes the form of things like billing Medi-Cal for a client encounter. So those things felt shaky. We knew there was need, and with your help, we put out two kinds of resources: general support grants to keep vital services available to the children, working families, and seniors who depend upon them, and then capacity building grants that enable nonprofits to step back, plan, and try to build a more sustainable business model for the future, which is basically boils down to increasing revenues and decreasing expenses through various means. Go ahead and page down if you don't mind, Luz. So this is in effect what I just talked about. And I guess if we can page down once more, Luz, the thing I want to say next, and I'm going to pass it over to Julia, is that we know this work continues to be vitally important. In fact, I would make the argument that this year's round of safety net grants will serve more people, will protect more families than last year, because in addition to the things we fret over at a macro level, as above mentioned, policy decisions beyond our control in Washington, inflation, conflict. Today, as we all know, we have local events to be concerned about because the primary engine of our community's prosperity for the past 4 decades, the wine business, is being battered by generational shifts in consumer behavior. So demand for wine is down, and on the winery side of things, there have been and will continue to be a raft of consolidations, acquisitions, exits, bankruptcies, layoffs, some of them quiet, some of them less so. Upstream of the retail market for wine, we have the grower community. And there are folk that had contracts that used to feel like annuities that no longer behave that way. Everything in this community is in some way tethered to that economic engine. So you've got the younger sister of hospitality that's a thing of the last 25 years or so. And you've got all the lawyers and accountants and insurers and bank lenders and everybody else who in some way is feeling or will feel that pressure. And I raise this not to distract you from the safety net, but to actually say we anticipate that in this period, just as we saw during the pandemic and just as we have seen after wildfires, that the kind of clients presenting themselves to the food bank or to the Family Resource Center are going to be middle income families who have lost a breadwinner. And so the need is increasing at a time when money is scarce, and thus our keen interest in doing this all again. So, with that said, I'm going to pass it to Julia.
Thanks, Terrence. Well, with the help of many of you last year, the first year of this fund, we invested a total of $1.65 million across 15 agencies, 13 of whom got $1.2 million in general support grants, which means they can use that funding how they see fit. And 11 of them got what we call capacity building grants, where this was funding restricted to investing in the kind of technical assistance they need to boost their business. 9 of them received both kinds of grants. And that combination is really important because it buys them time, it keeps the doors open on critical services, but it also allows them to invest precious monies that are hard to come by in strengthening their financial and operational footing. And so some examples of what happened in capacity building last year, there was a merger that was completed with Fair Housing Napa Valley. There was an executive search for a longstanding family resource center. There was some building of boosted financial management and billing systems so nonprofits could begin to explore raising revenue from brand new sources. I'm going to talk really briefly about 3 examples, and you may see these are familiar because they were recently featured in our newsletter. Page down, please. Parents Can, as many of you know, is a family resource center that helps families with children who have disabilities navigate the complex world of special education. Over time, though, because they're the first stop for families, they've become more of a full-service family resource center connecting these families who are often facing real challenges to other programs, like other safety net programs, like housing, food, childcare, employment. And last year, they had the double whammy of losing some of their own federal funding around these sources and having their clients face greater economic insecurity because they were also facing the loss of some subsidies. So the $100,000 general support grant was able to fill some of those federal funding gaps so that they could keep full staff helping those families as they were facing, some of the wobbling subsidies that they rely on. And the $40,000 capacity building grant we made just helped them to invest in expertise to start to develop a fee-for-service revenue model that will bring in net new revenue streams, like Medi-Cal or becoming a vendor for North Bay Regional Center. And that will help them stop playing financial whack-a-mole and actually have more financial stability into the future. Next slide, please. As many of you know, CHI helps low-income residents in Napa County access and maintain insurance coverage. They're the only nonprofit locally that can enroll people in Covered California subsidies. So their staff help thousands each year, and they were facing the loss of a very important state grant. At the same time, their clients were being notified that some of them were actually losing Medi-Cal eligibility. So the $100,000 grant kept them from having to make any layoffs so that they could keep helping all of their families navigate through the loss of insurance or needing to apply for new insurance. At the same time, they needed to fill some gaps in their own budget. The $40,000 capacity building grant gave them that space again and the ability to tap into professional expertise to start building new revenue streams so that they too, like Parents Can, could have more stability into the future. Next slide, please. And lastly, Puertas Abiertas, as you know, is a really important family resource center for Napa County's Latino and immigrant population. They are trusted. They provide referrals to other support. They have cultural wellness programs. They provide economic assistance in times of emergencies. They are a core partner of the Napa Valley Together Immigration Initiative. And last year, because of the hostile climate for immigrants in our community, they faced a 33% increase in client demand. They had more than 1,000 new people seeking services from them. So this grant actually helped them to expand to meet that need. And the $50,000 capacity building grant really helped them to invest in board governance and a brand new executive director so that they could provide those increased services without interruption while building stronger leadership for their organization into the future. Next slide, please. And I'm going to hand it back off to Terrence to take us to the close, but please drop your questions into the Q&A if you'd like, and we'll get to answering those.
Thank you, Julia. So last year we learned a lot. You always do when you follow the money and have a close partnership with your grantees and have trusted relationships where you can talk about how things are going, what's working and what's not working. In the second round of safety net grants that we are poised to launch soon, we have it in mind to do more or less what we did last year with a twist. Here's what's the same. General support grants are desperately needed to make sure that services continue, that staff don't need to be let go, that the working families and seniors and kids that rely on those services can continue to be served at a time when other things are shifting, like eligibility for Medi-Cal. With regard to capacity building, we intend to change things up a bit in two ways. First, we're going to over-index the fund towards capacity building, meaning that of the $2.1 million, thank you all, that we've been lucky to squirrel together. And could we really use 2.5? The answer is yes, friends. And if anybody on this call is interested in that discussion, I am here for you. We could go deeper and do more, but we are lucky to have what we have. And with what we have, we're going to allocate a little more than 50% to general support grants and a little less than 50% to capacity building. And we intend to be more prescriptive in that regard. And what we mean is we see three channels of opportunity based on what we observed last year. One is board governance, making sure that local boards are strong and on top of the details at a time of great stress for the organizations where their volunteer leadership basically makes the difference between A-list and B-list. The other is around, and I'm going to pass it to Julie to say more because I can't say more, about Medi-Cal and Cal-AIM, which is a new funding source that many local organizations have an opportunity to tap into, both for incremental revenue and frankly to hold on to existing monies they get from government, because that will be tethered one to the other in ways that implicate staff operations, because it's no picnic to build a government and be reimbursed. And few of these organizations have the capacity currently to be able to do that. And the last thread would be, and again, based on what we saw last year, which is we were able to help fund a merger. Do we wake up every day thinking, which of our favorite 16 charities can we consolidate into 12? We do not. The truth is that even on our finest days, when we're writing six-figure checks because of your generosity, we are still a minority share of the capital stack that makes these organizations sing every day. Having said that, I think in this moment, the conversation about sharing certain back office services, like nobody's got an accountant, could we build a thing that has that function that others, multiple groups could share, and the possibility of consolidations that would have to be the idea of our partners. We can never foist that idea upon nonprofits. It has to come from the ground up like it did 10 or 12 years ago when the two family centers serving St. Helena and Calistoga decided with our support that it would make sense to consolidate, et cetera. But that's the takeaway. More is needed, general support, and a sharper lens through which we will do capacity building.
I can talk really briefly about Cal-AIM, or as briefly as possible.
Yeah.
So the headline is, this is a good thing. This is the state recognizing that the social determinants of health have an impact on health. And so this is Medi-Cal essentially becoming available to pay for other services, not just traditional medical care. So housing, food, case management. But like most government reimbursements, it's expensive money and it requires quite a bit of compliance and adaptation of not just the business model, but the billing systems and the data capturing. CalAIM is also important, not just because it's net new monies for the family resource centers or the senior serving organizations that don't currently bill CalAIM. It's also going to be required under the state's Behavioral Health Services Act. So there are 11 to $14 million that flow from the state to the county of Napa, more than half of which usually flows to nonprofits in the form of grants and contracts from the county of Napa. Those grants and contracts now will require that if an agency is providing a service that could be billed to CalAIM, that it is attempting to bill to CalAIM. And that's my oversimplification, but in a nutshell, it's a great opportunity to bring in net new monies to diversify their revenues further. And it's also a bit of a stick to ensure that they are maximizing and leveraging all sorts of government dollars in order to be able to not lose existing contracts on which they rely.
So, Julia, I see a question from Barbara who wonders what the timing of these two tranches of year two safety net is going to look like. Can you speak to that?
Absolutely. So we're going to run this in sort of a three-phased approach. The general support is much needed as soon as possible. We're at the top of the fiscal year for many nonprofits, July 1 to June 30. So we intend to get those general support grants that open up the application period and get those out fairly soon in the next couple months. And then the capacity building piece will sort of run as its own engine starting very early in the calendar year, so in January. And the idea is to build a cohort model where not every nonprofit that's part of the program needs every intervention or investment, but there's also some shared learnings and peer support that come along with that. So that will kick off in January.
Super. Let's see. Any other questions, folks, in our twilight moments together? We've talked about timing. We've talked a little bit about CalAIM, which might be new to some of you.
We do have a question. How did you determine the 15, Paul asks? Well, there's never enough money to go around. And so we did a very rigorous vetting process in which nonprofits that met the definition of safety net, basic social services, basic needs, feeding programs, housing, medical, if they were in a budget size of a max of $10 million, provided multiple years of financial documents to us, as well as information about the challenges they were facing due to a changing funding landscape. And we were able to narrow it down to the 15 that had the greatest need, were providing the most critical services to the most residents, and really had the promise of these investments could make a difference between keeping the doors open or keeping the organization fully staffed.
I would just add on that there was, a sector screen, a size screen, and then a loss screen. And the loss screen was show us in your financials that money that you used to get, you don't get anymore, whether it's from philanthropy with a capital P or from government sector. That was year one, right?
Correct.
So it was tough, but we didn't get 80 applications in Fund 15. We got maybe 20, 22, because we always try to be careful, and sort of making the door that you knock on sort of the right size so that we don't disappoint a lot of people. So we try to be careful and transparent about what's on offer and who might get to walk through the door.
And I should add that this screen is not indicative of us thinking that any other sectors are less important.
Yeah.
This particular funding was particular to the safety net. And we also raised more money last year and this year to deploy through our Invest in Youth Education initiative to help with the educational nonprofits that are also facing challenges. So we know that it's tough sledding out there for all nonprofits. And the toughest job is to say, well, we need to narrow this to have the greatest impact, not specific to types of organizations, but specific to the types of services that the people in our community need most to survive. I'm not seeing any more questions, but if anybody has any for Jim as well, now's the time.
Going once, going twice. So I'd encourage anybody who wants to dig a little deeper in terms of what happened last year to visit our website, and there under the, oh, I forget, our impact tab, you can see some stories like the stories that we shared in brief. We'll certainly be talking more about this in our upcoming email newsletters and the like. We are really, really grateful to all of you for supporting us because we feel we are able to do something meaningful to step up and be of service at a time when our community needs us. And frankly, we don't get there without all of you by our side. So thank you for joining us. Any follow-up questions, you know where to find us. Look, there's where to find us. And I hope to see some of you in real life before long.